If you lease a vehicle, there are three parties involved. Lessor, meaning a finance company, lessee, like you and me, and the third party is a dealer who is selling the vehicle. Now, what is the agreement? The lessee approaches the lessor, says that, look, I need a vehicle, can you please finance? Then the lessor approaches the dealer, says that, look, we will pay you, you release the vehicle to the lessee. So the lessee take up the vehicle. He enjoys the luxury of the vehicle, and he also need to ensure any insurance, maintenance, any accident, all this he need to manage. Okay? So whose books this asset, this vehicle should be recorded as an asset? Lessee's books. Why? According to our original definition of assets, there are four conditions, no? If you remember, there should be a past transaction and event, and it should bring future economic benefits, and that also this should control by whom? That's the question here. This man is controlling. So that's why I brought that example where I was in another entity. I was finding it very difficult to explain what is substance over form. Then when I told this example, he said, okay, thank you very much. I understood this. I hope now you also very clearly understood. So that is the substance of. Now here we have the parent, we have the subsidiary. Why we need to produce a consolidated financial statement? Because it is in substance we are now single entity. Although legally two entities, we becoming a single entity. It's like one trouser having two pockets. No matter you have 10 riyal in this pocket or 10 riyal in this pocket, the value is to remain the same. As long as the 10 riyal goes to someone else's pocket, then the value changes. Understand me? So you prepare a finance for one side of the trouser and you prepare another finance for another side of the trouser. No use. Produce one single financial for the same one single trouser. Clear? So that's why we have to produce, and mandatory requirement is that you need to prepare separate financial statement that is governed by, you can say that, next para or next point. When the parent producing a separate financial statement is governed by IAS 27, separate financial statements. Now the question is this. This is the investment. I have invested 800,000 to acquire the shares of the subsidiary. In the separate financial statement, how am I going to deal with it? There are three methods to deal with this. One, at cost, at historical cost. Meaning 2 years before I have invested 800,000. Every time I produce my financial statement, I value this investment at 800,000. That is at cost. Second method, fair value model. What actually fair value model is, you see the market, check the saleability of, if I will sell this investment to outsider as of today, how much I can get? And you check that market valuation, which we call it fair valuation, and then you substitute or replace the value with the current market value. That is fair value model. Third one, equity accounting. We will discuss that in little detail later. What is equity accounting is actually if that investment is for associate. Now, this investment could be for subsidiary, this investment could also be for associate. If it is associate, the way you treat in your individual financial statement is this method. This is actually IAS 28 and these two IFRS 9.
28. These we are disclosing the value in the parent company.
Yes.
It is mandatory the initial itself either one of the
Now
things
let's
to
say,
follow.
today, 1st of January 2023, I acquire today. I pay 800,000 and acquire subsidiary B. And on 31st December 23, how I should show this 800,000? That's the question. You could either show at 800,000. That's originally how much you paid for. Or you can check the market and then find out the plus or minus. And then you represent that. That is fair value.
So in that situation there will be a revaluation.
Yes.
Plus or minus.
Exactly. And then how to take the difference? Now let's say market value says 850,000. So I have a 50,000 gain. So this 50,000 gain, how to take it? Is it to profit and loss account? Is it to other comprehensive income? That depends on how IFRS 9 tells you. There are different ways to treat those investments. We will discuss that there. But suppose if the value becomes 780, then only option 20,000 straight away take it to profit and loss account. But again there are some subjective argument. Last year you valued the asset at 825 and this year it becomes 815. Then there are 10,000 fall, but originally 25,000 increase. So now this 10,000 you may not take it to P&L as expense. You have to offset against the gain what you have taken. So these parameters you need to be wary of. Does that make sense for you? Is it clear? Very good. So now we can try this question. What they want? Statement of financial position of P and S. Okay. 31st December P purchased. Okay. It was investment. Can we try this question? What's the time of it? No, I will share this question. You try and come to the next class.
Yes. And off now.
This is you should be able to answer
Yeah.
because this is very basic.
Yes.
That is continuing from F3.